Mhm. So we have a lecture one, and our lecture is going to be about a short excursion into finance. And today we would like to discuss key objects and products of the financial mathematics. Let us think about it in terms of some example. Um, Example one, you are a young worker with a high salary, and what should you do? If financial markets exist and you have access to financial market, you can to deposit your money or invest in stocks, bonds to finance retirement, home ownership, education. But if you have an access to financial market, only consumption, what else? And the second example about if you imagine that you are a farmer producing oranges, what should you do? Again, if financial market exists, you have some possibility, for example, to hedge using future markets and to sell oranges at the present moment today when we haven't harvest of this orange, for example, and you can use weather-related derivatives that pay when there is an unseasonable frost. Um, but without financial markets, only the spot market available. You can sell only on this moment, and you can choose the price. So you see that if we have access to financial market, you have possibility to move your money from present time to future time, from one scenario of your life of nature to another. So financial market um, financial markets exist because it provides efficient allocation of resources across time, as in example one, and across states of nature, as in example two. Um, and you should to distinguish key object and structure of finance, which define and explain the specific problems of finance, of financial analysis. And this structure is individuals, corporation, financial markets, intermediaries. Um, let's begin with individuals. It's clear what are. It's you and I, and financial activity of individuals can be described as a dilemma to spend more today or to deposit and to give more in future. Corporation. Corporation, it's a different company, fabrics, farms, and other. Um, they organize business, manage manufacturing, and what is important, that can issue different securities for raising their funds. And intermediaries. What do you think? What are intermediaries? Um, can you say example, for example, intermediaries?
Brokers?
Please repeat.
Brokers?
Oh, I didn't say I didn't hear what you said.
Brokers.
Brokers. Thank you. Something, but yes, brokers, it is intermediates, but it is as in, maybe we can say this most widely. It is banks, different funds, some pension funds and investment funds and stock exchange where these brokers work. Yes, understand. So you see many links between this structure and you see at the middle financial market and financial markets because financial markets include money markets and markets of different financial instruments, including securities. Do you know how to translate securities? No? It is securities. It is a tradable asset, which represent position, ownership, creditor relation, not I can say it's tiny paper securities. So now you should distinguish what is underlying and what is derivative financial instruments. You see that there are underlying or primary and derivative or secondary. What are these? Underlying financial instruments, it is bank accounts, bonds, and stock. Bank accounts, it's easy, and I think you understand what is this. You can put your money on bank account and to obtain interest at the end of period. The bonds, it is for financial mathematics, the bonds and bank accounts, it is the same. The same. The bonds differs only in the form. It is as paper with face price, and you can get your money at the end of period, but every month, for example, you can get your persons as a coupon. Um, so the bond is a bond sorry, the bond is a debt securities, Um, um, bank accounts and bonds, we account that it is a riskless financial instruments. And there are stock, it is a risky, very risky security. About stock, I will say you later, today, but later. And what is derivative? What is derivative financial instrument? Um, um, it's called derivative because the price of derivative uh, depends on price of underlying asset. Understand? Derive from underlying, depends on underlying. And there are forwards, futures, swaps, options, and it will be in more detail later. So now I would like I would like to consider three possibilities for your choice. The first possibility to deposit in bank account. To deposit. No, I write 5%, for example. The second possibility to buy a risky asset, for example, stocks. But if you have enough money, you can to borrow before you can to borrow from bank, and only after that to buy assets. It is the second possibility. And the last possibility to use derivative. Um, and in this lesson, I would like to give you some mathematics for these possibilities. The first possibility, it's about to put into bank account. You should know about simple and compound interest rates. Maybe you know about this, maybe not. So simple interest rate to begin. An amount A invested for n periods at a simple interest rate of R per period is worth A multiplied 1 plus Rn at maturity. Do you understand this? So it is A, it is amount of money at the end of period, and at the end it's your money A plus A multiplying R. It's clear, yes? So we have write this as A and 1 plus R in the brackets. So it is the first year. But if we are talking about the second year, so it will be again only plus A multiplied R. So at the beginning it will be this sum A A A plus AR. I write in this form. But at the end of period, we have to add only A multiplied R. Yes, so it will be A multiplied 1 plus 2R, and so on, and so on. You understand? And if we consider the n here, it will be A multiplied 1 plus 2 times n. Understand this? Yes. But if we are talking about compound interest rate, difference is in follow that not we not add only A multiplied R, but we multiplied on this bracket. So if we have that A at the end of period and at the beginning of period, and we have A multiplied 1 plus R at the end of period. And if you would like to consider the second year, so we have A multiplied 1 plus R at the beginning of the period, but at the end of period we multiplied the initial sum for this second period, multiplied all this, multiplied 1 plus R. So we take to account and this sum A multiplied R, and we have 8 multiplied this 1 plus R squared, and so on. No, maybe you know this. Um, I hope you know this. And now I would like to say about periodic interest rate. What is this? It is if we have 1 year, for example, 1 year, and we divide this year for m equal periods, and now we would like to derive what will be formula for simple interest rate and for compound interest rate if there are this scheme. So for this period, the interest rate will be R divided by M. But if we have n years, so this period there are n multiplied m periods. So what is for this formula? For this formula, it will be A multiplied 1 plus, instead R we write R divided by M, and instead N we write N multiplied M. And you see that we have the same formula. Nothing changed. Yes. But what is about this formula? Instead R we write R divided by M. Yes, instead of this, and instead N we write this M multiplied N, and it's a new formula for periodic compound interest rate. And this formula is very interesting if the amount, if a number of this period tend to continuously. So in this case, we write limit and and what you can say, we can write before limit, yes, and you know about this? If we have one plus any fraction, for example, this, and it is to the power of fraction m divided by r, and it will be what is it will be? Who knows? Who would like to say?
Exponent.
Yes, yes, it will be exponent. It will be exponent. But you see that you see this m divided by r, but r I should to multiply it, yes, and n I should to multiply it. So this exponent to the power rn. So uh, in this case we write no n by t. So so rt equals r initial or r0 multiplied exponent to the power rt, and its formula for continuously compound rate. And now you can see this on this slide. You see, it is the same. So we have a new formula, continuous compounding interest rate. And what is interesting, it's really interesting and important for essential for our course, these differential equations. What does it mean? It means speed. Yes, how change this amount respect to time, and this speed is proportional to amount a at the time t, and proportional some constant r and its interest rate, and uh, and there are given that this amount at the initial moment t equals 0 was for example a sub 0, do you remember how we can to solve this differential equation? It's differential equation of first order, yes, of first order, but how we can solve this? Who remember?
Integrated.
Yes, the way of solving is integrating, but can we integrate this left side?
No, we should multiply that by
Yes,
r.
yes, thank you. So the first step to multiply by dt, after that to divide by a capital T, yes, and it will be dA sub t divided by a sub t equals r multiplied dt. We separated, yes, we separated this value, and after this we can integrate, and on the left side it will be what it will be.
ln of the
Yes, ln of a t And in this side, it will be its constant, Rx constant. So I write R and multiple, it is T and plus ln constant. No, you can write only plus constant C, but it's more convenient because now we move this at the left side, and it will be ln R T divided by C equals R T. And after that, ln E exponent to the power at T equals equals A divided AT A sub T divided by C. And from this we can write that A sub T equals C multiplied E to the power RT. RT. What is our formula? And now it is Cauchy problem. If t equals 0, if t equals 0, it will be a sub 0, and exponent to the power 0, it will be 1. So c equals a sub 0, a sub 0. So the final formula will be a sub t equals a 0 multiplied e to the power rt. Yes, and you see that it is the same formula. It is the same formula, and it's formula for continuous compounding interest rate. All this in all this formula, you saw that the amount depends only on time, So money change during the time. But the second, oh yes, and this is the first possibility that you owe $20, for example, in your pocket, and you have decided to deposit, and what's your profit? What's your profit? So it's no, it's for example, simple interest rate. But if you have only one years for this for your possibility, so it doesn't matter if it a compound of simple. So we have $20 initial amount, and at the beginning of an amount, but at the end of amount we have 20 multiplied 1 plus 0.05. But if you would like to use continuous compounding, just 20 multiplied e to the power 0.05. And it will be, it's easy, yes. it will be 21, and this approximately the same. So your profit is only net profit only $1, but it riskless. It riskless. But how can we raise the profit? How? If we have a possibility to change interest rate, and if we don't have more money than 20%, how? Um, there are not other possibilities in this way to have more profit. Understand? Um, I'm making it clear. Mhm. And we move to the another possibility, a risky asset. For example, stocks. Stock is security what represent value ownership that can be converted into cash. Into cash. And please listen carefully, because after this lecture, at the end of today's lecture, you have to answer on the test about this material. Um, well, about stocks. On this picture, you can stock in, I don't remember, in 19 years, maybe. It is stock certificate for 10 shares of the Baltimore. And I would like to repeat that the stocks, it is a very risky asset. They are very fluctuated. Um, because at any time the price is balanced between demand and supply. Um, and Louis Bachelier was the first who considered moving of the stock prices a stochastic process. It was in 1900, and um, and it looks that the demon of chance draw a random number and add it to the current price to determine the next price. Really, a stock exchange is a black box or a live organism that input information and output behavior according to the rules to be deduced. What is these rules? Maybe it is the aim of the our next lectures, but today only about our possibilities. So the second possibility is to trade stocks. So you own $20 as before, and but for example, stocks cost 600. If it is it is good, nice company, their stock are very expensive. So you have to borrow from bank 580 for this aim, in order to buy these risky assets. And we now consider time to maturity only 1 year, and we know that in 1 year, the price can go up. Today, we buy for $600, and we know that maybe two scenario in the future. The up scenario, it is the price will be 650, and the down scenario, the price will be 550. 550. Um, so, what's your profit in this situation? In this situation, we have two scenarios. So we should calculate profit in both scenarios. Yes. So let's consider the up scenario. At the end of this period, you buy your stock and you have 650 in your pocket. 650. But you remember that you borrowed from bank 580, so you should repay this. It is 580 multiplied 1.05, and now I use calculator to compute what is this sum. This multiplied with this, it will be 609. So this difference is $41. It is no, it's really net profit, and it's very cool. It's very cool. Because you have $20, yes, invest, but at the end of the period you obtain $41. It's more than 100%. So yes, it's cool, but it's up scenario. But let's consider the down scenario. In down scenario, we buy your stocks only for $550. So $550, and we should repay this sum 609. But you haven't enough money for this repayment, yes? So it will be with minus. So it's not profit, it's loss at 41. Yes. 40 minus minus 59. Yes. And what can you say? What can you say about this possibility? Do you like this possibility?
No,
No. Yes. Why? Why? This profit is great,
but
but
the loss is greater.
this loss is really trouble. Yes. it's really trouble. And if you made that that you buy not one stock but 10 stock and borrow from bank money for 10 stocks, it's a very great trouble. Yes, so it's a very risky possibility, and stocks is really a risky instrument because market price of stock is very fluctuated. So the question two, how can we reduce the risk? Um, there are many different theory about this. It is portfolio theory that says that you shouldn't to buy only stocks of one company. And the most popular, it is the most popular, it is using derivatives, and it's new for us. So please listen carefully about derivatives. Derivatives are a contract or agreement between two parties. You see buyer and seller, and price of derivatives is depend on the underlying asset. It is maybe stocks, maybe gold, maybe oil, and so on. Um, if you use derivatives, you shouldn't to buy gold, oil, um, or stocks. You buy only possibility to buy in the future, and I will explain it again later, sometimes. So derivatives. It is this agreement, and um, this agreement can be in the different form. It can be as form forward, futures, options, and swaps. Um, if you want, you can read about all this form of derivatives in the handbook, and this handbook uh, you can find in the distado. It is this book is called the different derivatives, maybe it is something like that. Um, in this course, um, the focus of this course only on the call and put options, but about other derivatives, you can read more deeply by yourself. But now a few words about forward contracts. What is forward contract? A forward contract gives the buyer the right and also the obligation. No, it's as agreement. In any agreement, you have as right as obligation to purchase a specified amount of uh, commodity at a specified time at a specified price. And you see on this picture, for example, that two persons, buyer and seller, agreed, for example, on the December 12th, but the change of commodity will be only on December 15th. Yes, and it's why it calls forward contract, because it's not about today, about present time. It's about future time, and it may be delivery of stock or sale of gold or converting euro or T-bill. T-bill is as bond. Understand? And you have to distinguish difference between a long and short position, and you can understand what is payoff. Payoff. So, what is a long position? Long position. Long position. It is position to buy. Position to buy the underlying asset on a certain specified future date for a certain specified price. A short position, it is the position of the other party, and its position to sell the asset on the same date for the same price. And it's worth to mention that forward contracts are very popular on foreign exchange. Um, on this picture, you can see you can see graph. You can see graph. Its graph it is a straight line, and the x-axis indicate the price of stock or currency, but the y-axis indicate payoff. Payoff. So, but payoff it is as profit, but it's maybe not net profit. It's on the profit only payoff what in this moment. So if we agree about buying or buying any stocks, for example, no, for this specified price K. No, for example, K $100, $100, and if this price will be more, for example, 110. So this is difference. It is profit for long position, but it is loss for short position. Yes. So if I rewrite this in terms of y and x, profit it will be y equals s it x. Yes, x minus k. And now you see that it's very simple. A equals x, it is straight line bisectors, and minus k means that this bisectors we should move on k unit below. Yes, but in this case, y equals k minus x. So it's minus x plus k. Minus x plus k. In this case, it's y equals x, and this y equals x minus k. Yes, you understand? For example, it will be 100, and we agree to buy stocks for $100. But if this future moment uh, came in, so for example, it is the current price is 110. So you are glad because you have possibility to buy for 100, but current market price is more. So this difference is your profit. Understand? And about swaps we haven't time about this future contract. It's very similar uh, to forward contract, and it's maybe yourself and the option contract. It's very important for us, and it is contract agreement too between buyer and seller. But what is difference? The buyer of the option gets the right, but he is not obligated to buy or sell the underlying stock. Understand? It is agreement, but only with right, but uh, but with no obligation. The buyer will only do this when it's profitable. It's very useful. But what can you sell about this possibility that we have only right and we haven't obligation? What can you say? Is it possible? What should be um, that it will be possible? It's not free contract. The answer is not free contract. So about this last possibility, you own gain $20, and you have decided to use option, stock call option, um, with strike price 610, and this it is time to maturity is 1 year. So it is as in previous example, we have that initial price 600. It is about stocks 600, and there are two scenarios. Up scenario, the price will be is going to be 650, and the second scenario, the price is going to be 550. And you have agreement, and in the agreement pointed the price 610. It is this, yes, 610. And this pointed price is called strike price. Is called strike price. Strike price. So, so you understand that in case of up scenario, this difference between 650 and 610, this difference, it's your payoff. It's your profit, but not net profit, only profit. It's your profit. But in this scenario, so I write. I'm going to write this. The F scenario, 650 minus 610, and payoff 40 $40. But what did you understand? What will be it down scenario? Who would like to say? Who would like? What's payoff? What's payoff in the down scenario?
Maybe 550 minus 610.
No, Maybe there are another opinion. So let us let us I remember you that it is uh, not obligate. It's obligation. It's only right to exercise this agreement. So you have agreement, and for example, you see that it is this down scenario. You don't have to use your agreement. Understand? So who would like to say what's Payov in this scenario?
-50.
Mm-mm. Please, anyone who would like, I would like to say different opinions. I would like to hear, sorry, different opinions. I would like that you say different opinions. Maria, Vera, Vera, what do you think? Vera, are you here?
Yes, I'm here, but I don't know.
Maria,
Well, maybe
Olga, Maria, Olga. Maria, what do you think?
maybe it would be 0 because we don't have to use
Yes,
0.
yes, you are right. Wonderful. It's zero. It's really zero because it's not obligation. It's only you're right. You're right. If you want, you exercise this derivative. If you not, you can throw it into trash. Into trash. So in this case, you should throw into trash. Um, bucket, the trash bucket. So in this case, it is zero. It's Payov function. It is Payov function. Payov. It's very important to understand Payov function. Payov function. So this scenario, it is s minus k, but in this scenario, it is zero. It is zero. But net profit, net profit, net profit. It is something another. It's not only Payov. It is net profit because I say to you that it's not free contract, and you should to pay premium for this contract. And for example, this premium, no, for example, $20, $20. You have $20 and it's premium. So net profit, it is 40, 40 it is for you, and minus 20 in the up scenario, and in this scenario it is 0 minus 20. So so you see that in this case we should obtain net profit, but it's not profit, it's loss, but its loss is limited, always limited. So it's great. Uh, and I see that I have a little time. So you should distinguish what is premium, what is strike price, what is stock price, expiration date, and that there are two types of option. It's call option, it's right to buy, and put option, right to sell. And if we compare these graphs, forward contract and option contract, you see that there is difference between the payoff function, not only s minus k, but uh, but s minus k only if s more than k. So in this case, in this half of plane, it is the same as forward contract. But at the left of this, it's another picture, because if s minus k, it will be payoff 0, but net profit minus p. So you should write about this carefully at home. What is this difference, and what is difference between European and American option, because it is will be discussion on the exercise lesson. And summary, you should know that why finance markets exist, and what is non-risky primary financial instruments, and their price depends only on time, and there are risky instruments, and each stocks is very fluctuated, and there are derivative instrument, and but we can think about reducing risk, and mm, fair price fair price of the premium of this option is one of the main problems of the conventional mathematics, and it is your handbooks, and you can find this in the distillery, and I recommend John Hall, and I write on the page, and maybe this is the end of lesson. Thank you for your attention, and now please, it's time to test. You can find this test on this to do, and on the practice lesson, it will be 11:40. 11:40 will be input test, but maybe maybe we meet in Zoom. What do you think? Maybe you have any question. Let us. I sent you invitation. Okay.
So we should write input test on.
Now, yes. Now you should write test. I thought that will be 10 minutes for this, but maybe no. If you want, you can now rest, and after break we can start it. So I sent you. I sent you invitation, and we meet. And now, bye bye, and thank you for your attention that you were here.